This is Takashi Kotegawa, a college dropout who became a trading millionaire overnight. Well, not exactly overnight. It took him 8 years to turn his $13,600 investment into a $153 million profit. No trading courses, no masterminds, and not even this channel. Still, Tekashi managed to build this massive portfolio. How did he do that? Simply by creating and following this unorthodox strategy. His strategy is so unhinged that most traders today would warn you to not even think about it. But during the early 2000s, Tekashi himself made millions with it, and who knows if he's still doing it. And before we dive in, if you want to see more proven strategies like this that actually work, strategies that turn regular people into millionaires, make sure you hit that subscribe button and turn on notifications, because I'll be breaking down one legendary trader's system every single week. So what made Tekashi's approach different? Well, it all comes down to these core principles. Understand the market beforehand. Buy panic, sell relief, risk a small percentage, exit without greed. Now, these 4 principles sound simple, right? But here's where 90% of traders mess this up completely. Mistake number 1. They buy the dip too early. Most traders see a stock down 20% and jump in immediately, and then they watch it drop another 30%. Tekashi never did this. He waited for 3 specific confirmations before entering, which I'll show you in a minute. Mistake number 2. They use the same percentage for every sector. A 20% dip in tech means something totally different than a 20% dip in banking. If you're using one rule for everything, you're going to lose money fast. Tekashi understood this better than anyone and adjusted his entry points based on the sector he was trading. Mistake number 3. They hold too long. The average trader turns a winning day trade into a losing swing trade because they get greedy. Tekashi's rule was simple. Take profit before the session ends, or within 2 to 6 days when the market gets calm. To be honest, Tekashi's game plan started way before entering into it. He said in his interviews that before investing in stocks, he used to study charts during his job at a restaurant. He studied every panic, company news, bad results, and understood how each of these aspects affects the price action. To him, charts are more about understanding human emotions than doing difficult math, because people repeat the same mistakes in the market every single day. Once you understand that, you don't need predictions. Tekashi started his trading career in 2001 with an initial investment of 1.6 million yen. Every day, he'd look for stocks that have fallen due to some bad news from the company or any controversy. These red charts were his main playground. He'd keep an eye on gradually declining stocks so that he can benefit from their reversal. But it's not that easy to bet and win on these long-term bearish trends. You need a foolproof strategy to outshine the market. That's where Tekashi's super simple trick comes into play. It's so easy that most traders overlook it, but if it's used the right way, you can book multiple short-term profits. First, Tekashi would use moving average divergence. With this indicator, he'd look for stocks that had fallen 20 to 35% below their 25-day moving average. To make you understand this better, a moving average is simply the average price of an asset over the last few candles. It is updated continuously as new prices come in. So a 20-period moving average means it's averaging the last 20 candles. So once Tekashi spots a trend of his interest, he'd buy that at the lowest limit and hold it for 2 to 3 days to confirm whether the stock is really in the trenches or it was just panic. For example, if a stock falls from $100 to $90 due to panic selling, Tekashi would buy at $91, wait till the panic fades, and the stock bounces back to $95, and then he'd exit. Most of his early trades were small wins which came from buying stocks high in volume and liquidity. Now before you think, oh, this is so simple, let me just copy this in my trade, wait a minute, because this is exactly where most traders lose the track. They assume one size fits all. But Tekashi understood something crucial. Not all stocks behave the same way, even with the same technical setup. See, if the entire market is crashing, even the strongest support levels won't really matter. The overall mood just pulls everything down with it. On top of that, different sectors react differently. Some drop fast and others barely show any movement. But the sectors Tekashi chose never crash down. How did he figure out which sectors were worth his time? He simply studied every sector. Before investing a single penny, he'd enlist 50 different sectors and study their past trades. For example, if he's planning to invest in rising markets, he'd track the core companies in each sector, like Nippon Steel or Kobe Steel. If the market was going up and most stocks in that sector were rallying, but one stock was falling behind, that's where Tekashi would make his bet. He'd buy the dip, expecting it to catch up with the pack. And most of the time, it did. This kind of observation taught him which sectors moved predictably and which ones were just noise. That's why he eventually narrowed down to sectors that had high liquidity and recovered quickly. He adjusted based on the sector he was trading. For volatile sectors like tech, he'd sometimes wait for bigger dips, like 35% to even 65% on penny stocks. And for stable sectors like banking and retail, which he favored for small wins, the 20% to 35% range worked perfectly because these sectors recover quickly and are more predictable. The point is, there's no magic number that works for every stock in every condition. You have to adapt. Takashi chose his sectors wisely. Banking and retail became his favorites because they had high liquidity, quick recovery potential, and smaller risk thresholds. He wasn't gambling on 10 different sectors hoping one would hit. He focused on what he understood and what consistently delivered. Takashi always knew there are levels to this game, and when I say levels, I mean it. Applying moving averages and enlisting sectors doesn't make you millions. You need more precision to confirm the market's next move. For that, Takashi used indicators like Bollinger Bands and the Relative Strength Index. Now, if you already know what these two indicators are, skip ahead 30 seconds. But if you're new to trading, pay close attention because I'm going to explain this in the simplest way possible. If I say Bollinger Bands are an advanced version of a moving average, it won't be wrong. Because if you look here, the middle line is just a simple moving average, and the two outer bands show the market volatility. When the price touches the lower band, it usually signals that the market is oversold and may be ready to bounce upward. When it touches the upper band, it suggests the market is bullish and may cool off. For better indication, you need to focus on the width and tightness of the bands too. Tight bands like this one mean price action is low and a big breakout could be coming, while wide bands like the one here confirm a strong trend. Till this point, Takashi's strategy only works 42% of the time. But if you combine it with RSI, it jumps to 61% because this combination can confirm whether a price move is truly strong or just an overreaction. Bollinger Bands show when the price stretches too far from its recent average, while RSI reveals whether the market is overbought or oversold. So, if the candlesticks move outside the lower band and the RSI shows an oversold signal, it's a strong indicator that the market may be ready to bounce. The same happens on the upper band, where an overbought RSI hints at a possible drop. This combination filters out false signals because you're not relying on just one indicator. For most of his trades, Tekashi used this to time entries when both indicators agreed the market was stretched and likely to reverse, and to exit when RSI returns to normal levels. Now let's rewind all the steps Tekashi took to turn his $13,000 into $153 million, so you can just simply copy them. First things first, spot a big crash in price. Surf different sectors to find the stocks that have significantly lost their share prices. For example, if Takashi's still trading today, which most people believe he is still a day trader, he'd pick the two biggest companies of totally different sectors. One is in biotech and the other is in consumer discretionary. Both are facing a dip over the past few months, which signals panic selling, but this crash doesn't mean they won't rebound. Next, check the moving average and RSI for confirmation. If the price was more than 25% below the 25-day moving average, it means the stock was much cheaper than its usual price, which is a strong sign it might bounce. And if the RSI shows overselling, you can trade this stock because oversold usually means buyers may soon step in. Don't rely 100% on indicators and wait for the first green candle. Instead of buying while the price is still falling, wait for a green candle that shows buyers are stepping back in. Enter the trade long. Once the first confirming green candle appears, buy the asset, which will likely bounce upward. Take profit before the session ends. Just like Tekashi, you should prefer to close most of the trade the same day to avoid overnight risks. But in some cases, you can hold the asset for 2 to 6 days to confirm the market direction. Let a small portion run. Always keep a small position open so if the price continues rising the next day, you can capture extra profit, which is exactly what happened when Tekashi made a $1 million trade. What's the conclusion of trading the Tekashi way? By making trades in a volatile market when it's oversold due to any crisis or panic, you can book small but consistent profits. Sure, you will lose some money in the process, but as Tekashi said, if you care about money, you cannot successfully day trade. So if you follow Takashi's strategy closely, the win rate can go from 0 to 60%. And that's all for today. Don't forget to like and subscribe to the channel, and I'll see you in the next one.